Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your rates rundown for January 16th, 2026. This has been a fairly slow week as it relates to mortgage and interest rate markets, which was nice considering how dramatic the first full trading week of the year was. So, in this case, I would say boring is pretty beautiful. Let's start by taking a look at the numbers. Since last week, 10-year Treasury yields are higher by about 6 basis points to right around 4.23%. Meanwhile, mortgage rates are up by about 17 basis points. Inflation data is what we were focused on this week. And before we get into the numbers, let's explain one definition, and that is the definition or the difference between headline and core inflation. So, headline inflation is essentially the number as it's calculated with all inputs taken into consideration versus core, which removes the more volatile pieces represented by food and energy costs. So, headline CPI, that's consumer prices, came in right on the button, and core CPI was slightly lower than that. A similar dynamic in producer prices, as measured by PPI. Year over year was a little high, but the most recent month was right in line with expectations. So it's good. It's good that inflation isn't running above expectations, but we also need to acknowledge that expectations aren't exactly aspirational right now. Both expectations and actuals are running above the Fed's 2% target, and that is not ideal. Despite this, mortgage rates managed to hang on to some of last week's gains. According to Freddie Mac, mortgage rates are now a full percentage point better than they were 1 year ago today. Lower rates are logically translating into a surge in borrower activity. Refinance applications jumped significantly this week, and purchase inquiries climbed as well, suggesting, as you might expect, housing markets are responding to declining borrowing costs. Tight supply means that home values will continue to be very well supported out in the future, but it also means that affordability constraints are going to continue to be an obstacle for first time homebuyers. The next Fed meeting is less than 2 weeks away. Futures markets put the chances of another rate cut at essentially zero. Markets are still pricing in a fairly high probability of one, possibly two more rate cuts this year, but likely not until after we get a new Fed chair, which will be just before the June meeting. Before you go rooting for additional rate cuts, let's remind ourselves of one fact: the Fed does not control mortgage rates. As we have seen in the past, the very recent past, in fact, sometimes Fed funds rate and mortgage rates move in completely different directions. This is especially true when we're struggling with inflation, which continues to be the case, right? Rationale there is that lower borrowing costs encourage more spending. More spending encourages more inflation, and more inflation means investors will demand more compensation the further out in time that they invest. We saw this very phenomenon happen in late 2024 when the Fed cut 100 basis points off the Fed funds rate, and mortgage rates actually went up by about 110 basis points. And we're still seeing it now, right? The Fed cut 75 basis points between last September and last December, and mortgage rates are really only improved by about 15. So the bottom line here is that as mortgage folks, we are not, in fact, rooting for additional Fed rate cuts. What we are rooting for are solutions to the fundamental issues that are making long term investors require that higher compensations. Mortgage rates tend to be, or seem to be settling in here, perhaps off their absolute best levels, but still very, very near the best levels we've seen in 2+ years. We could feasibly see some modest improvement if macro conditions soften further, meaning it mostly means jobs, but could also be falling growth, decreased consumer spending, etc. But it's unlikely we'll see dramatic improvements from here absent some participation from broader rates markets, specifically 10-year treasuries. And for that to happen, we need to see one of a few things: that the inflation issue is definitively licked long term, a dramatic shift in policy, and that is something more impactful than just the discrete 200 billion that we discussed last week, or potentially signs that the softening in macro conditions is progressing into bona fide recessionary fears. That's all I got for you this week, folks. We will see you next time. Have a great weekend.